Are you a hardworking dad, juggling family responsibilities while dreaming of building wealth through real estate? Welcome to the Invested Fathers Podcast, where we explore how to balance investing and fatherhood. I'm your host, Kenny Johnson, founder of East West Capital. Over the past 5 years, I've been buying real estate to free up my time and secure my family's future. Now I'm here to help you do the same. Join me as we navigate the real estate world together, building wealth and strengthening our families. As my grandma always said, East West, home's best. Today we're going to be talking about the difference of investing into stocks versus real estate. And this has been a topic I feel like that continues to pop up with colleagues and a lot of other investors I have. And I think it's a really good conversation to talk about. In my experience, the common investor has started in the world of stocks. My dad sat down with me when I was 12 years old and taught me about stock growth and yields and dividends. And that was exciting for me. And I think that was exciting for him to share that with me. My dad also invested in real estate, but didn't have quite as much of a entry-level conversation into doing that. So we're going to talk a little bit about, what are the pros and cons of both real estate and stocks. This conversation actually was probed to me pretty recently with an investor who said, I'm investing in an index fund that gives me about a 14% return over the last few years. Maybe it's averaged like 12% over the last 10 years. Why would I switch from putting more money into that over real estate? So that was what kind of sparked the idea of having this episode. So let's just get right into it. I'm going to start with the 5 reasons why investing into stocks is better than real estate. Before I list these reasons, please note, everyone has their own level of risk and level of comfort in investing and just different pursuits and goals. And that's all good. I think you would be wrong by not listening to this type of episode to say, like, what else is out there? Hey, if it's not broke, don't fix it. I know there's a thought out there, but there's also the thought of, why not refine and improve something that could be better. So at the end of the day, every investment has a level of risk to it. There's no guarantees. Anything could fall. It's just a matter of, how secure, risk aversion. And then also to note, I'm not a financial advisor. I know a lot of financial advisors. From my experience with financial advisors, and they're not all created the same, of course, their job is to give you a script of available options that are vetted through their company. There's things that are on market that are available, and there's things that are off market that, don't pass their test to invest into. So I am somebody who am off market, and the deals that I do are not, vetted through a financial advisor agency because it just wouldn't make sense. The size of my teams and their setup are not something that an Edward Jones would be able to have in their books. So keep that in mind. I don't feel like I'm working against financial advisors. I am just a different option. So here we go. So here are some of the key downsides of investing in real estate compared to stocks. The first one I would say is illiquidity. Real estate is not as liquid as stocks. So it can take time to sell a property, often months, especially in slower markets. So stocks, on the other hand, can usually be sold almost instantly. And I'll overlap that with, like, what are your goals in investing? Is it to be able to pull out your money quickly? I think that depends on if you're on the beginner stage, growth stage, or ender status of the timing of what you want to do with your money. Second one is high entry costs. Buying real estate typically requires a substantial amount of upfront investment, like down payments, closing costs, property improvements, to make that something, that is a viable asset that brings in money. Whereas stocks can be purchased in small amounts, making them more accessible for a wider range of investors. That's a huge one. And I think even as I list these, I'm thinking it doesn't have to be. You don't have to buy the whole property There's ways to finance a property, um, and there's ways to partner into properties as well. So we'll get into that in the next section, but let's just put a pin in the fact that it is uh, easier to buy stocks at lower dollar entry points. Agreed. Management and maintenance. Owning real estate, especially rental properties, require ongoing maintenance and management, whether it's dealing with tenants, repairs, property management companies, whereas stocks is largely passive once purchased. This can be combated through syndication. So owning real estate does not mean that you have to be the landlord. And I think that's a little bit of the aha moment for a lot of people right now is, are there ways that you can reap the benefits of real estate without being the head honcho who is pulling all the levers and taking those phone calls? Of course, those people are going to have a higher equity stake in the business plan. But hey, if you're loving what you do and don't want to buy another job, don't become a landlord. 4 is market sensitivity. Real estate can appreciate. It also can be subject to downturns. So economic factors, local market conditions, interest rates, those are all significant impacts on the property value. Stocks are also volatile, but tend to recover more quickly after market downturns compared to real estate. This is totally dependent on what kind of stocks you buy and real estate as well. I have owned stocks since I was 12 years old. I think at one point I had around $60,000 in the stock market. I now have closer to 30,000, maybe less. And the only reason I have that is because the stocks that I have dipped and have not gone up over the last 2 years. And I'm hoping they do go back up one day, but don't feel it is in my best interest to sell those until I can see a little more of a rise. So the 5th one would be concentration risk. Real estate investments are often concentrated in one or a few properties, leading to a lack of diversification, depending on how many you own or what markets you're investing in. Stocks, on the other hand, allow for easy diversification across sectors and markets, reducing overall risk. Let it also be noted that you can invest in different markets and even different asset classes in those markets with different strategies. So for instance, I could be doing fix and flips locally because I have a team set up here and the market is very good for that if you can find a good deal. And I'm investing into multifamily apartments in Kansas City because they have strong rents, growth, and huge demand for that kind of thing. Or I could be investing in a mobile home park in Texas. So there's just a lot of ways that I think you can diversify even within real estate. I also want to talk about the mindset of investing in stocks. This sort of hit me not too long ago when you are told from your employer, if you have a boss, not everyone has a boss, but hey, work for me and we will incentivize you with a 401k. And the longer you work here, the more stock you have in our company. And, we'll match, a certain percentage of what you invest from your paycheck into this stock. And hey, that can work very well for a lot of people. However, if you are looking at it, it also helps that employer as well in regards to you staying with them. So I think that if you carry that across the nation, stocks seem to be the more common way to go. And I think that's why a majority of people start there and stay there. And as you get older, and I feel like maybe you come into more money or start making your own nest egg, you start thinking more about what are my options in investing. And unless you know somebody who's already invested in real estate, or you're just very curious and are okay with, sort of breaking outside the mold, then you're probably just going to stay investing in stocks. Again, my opinion, not everyone out there would agree with that, but I just feel like the real estate bubble or entry feels like too hard to get into, especially if you don't know about syndication or do have a type of partner in your life that you could say, hey, could I give you, 30K, 50K, 100K, and we could buy real estate together. Hey, you can invest in businesses, you can invest in gold, you can invest in crypto, lots of things out there to invest in. But let's now dive into what would be the benefits of investing in real estate and could possibly turn my head into doing that, given some of these reasons. All right. So the first one is going to be tangible asset. So real estate is a physical, tangible asset that investors can see, touch, and improve, unlike stocks, which are intangible. This tangibility often provides investors with a sense of security and control. So when I talk about buying a house, 10 minutes away, an investor says, hey, let's go look at it together. There is just a huge sense of, okay, I can see this house has, broken windows, curb appeal looks terrible, bushes are overgrown. So what are you planning on doing to it? Oh, you're going to trim the bushes, you're going to replace the windows, you're going to do new flooring. Okay, that makes sense that once you do these things, you will improve the property to how much? Oh, what are the comps? What are things that are selling nearby? Oh, okay, this sold for 300,000. This is probably gonna be worth close to 300,000 once we do this to it. So there's a lot more, I feel like, connection to like the business plan that can be quickly and easily understood, versus maybe stocks where you potentially feel like you're just rolling the dice on, well, we can look at the history of these things, but who's to say that, I don't know, the CEO isn't going to do something crazy or some other outside influence that could just plummet the stock or at least dip the stock that you just have absolutely no control over. Second reason to invest in real estate over stocks would be cash flow and passive income. So real estate investments, particularly rental properties, can generate consistent monthly cash flow after mortgage payments and expenses. This passive income can be more reliable than stock dividends, which are typically lower and depend on company performance. Let's just take the example of a mobile home park. So you can look at a business plan of, hey, we're going to buy this mobile home park. It's currently bringing in this much. It's currently costing us this much. And over time, we're going to improve the area, add in better roads or, Wi-Fi or some other like benefit. And we're going to increase the rent to this much. It just seems, again, very easy to digest and understand. And when you see that monthly cash flow every month, it feels good. Now, a tenant doesn't start paying, there's evictions, life stuff happens. Yes, like there's still pitfalls that can happen in real estate. So that goes over to the property management side of things. Let's go to appreciation potential. That's number 3. Over time, real estate tends to appreciate in value, particularly in desirable areas. Yes, hot markets. While both stocks and real estate can grow, real estate has the added benefit of being leveraged. This is huge because this means that you can buy a large asset with a smaller amount of cash upfront. I'll use the example of the first rental I bought, and this is a conversation that's probably more directed toward the passive investor. But as the active investor, I was able to buy a $127,000 property, 6 houses down from where I live, and I put down 15%, which was around $22,000. And after closing costs, and after even renovation costs, and then the refinancing costs after I fixed it up, I was all in at around $45,000 out of my pocket. When I refinanced on that house, I was able to get a renter in the house, which had already given me, let's just say $4,000 in rent before I even refinanced. And the property was worth $256,000, which means after I refinanced on it, I actually got a check for like $60,000, which means I paid myself back and I put $15,000 in my pocket and I owned the property, which someone else was paying the mortgage down for me. And there was approximately $5,000 of equity still in the house that was mine. It was not liquid, but over time that has only grown. So I bought that house 5 years ago. Today it is worth $320,000 or so. And there's probably still some updates I could do to it. But that's a success story of buying something leveraged. And then, I mean, there's lots of leverage. There's situations where you can buy things where person doesn't want to list the house because they don't feel like they want to deal with realtors or showings, or it just needs a lot of updating, and that might be a hindrance to selling the house because person doesn't want to update it. So anyway, leverage is a very powerful thing in real estate. Tax benefits. This is another huge one. Real estate investors can take tax advantages of several tax breaks, including depreciation, mortgage interest deductions, tax deferral opportunities such as a 1031 exchange. And these tax advantages are not typically available with stock investments. For those that are making a lot of money out there, the business is doing very well. This is sort of the no-brainer. I was talking to a guy today, and I've told him, hey, at least in my world, I have the ability to really place you in two buckets. We could put it in this sort of fund, your money in this fund vehicle that more or less helps renovate certain properties, but that's not buying real estate. You're buying a security sort of tied to real estate, and we can get like a promissory note and tie this money into a specific property that basically is like putting a lien on a house that allows me to, update the property. And I will not be able to sell the property or refinance or anything on the property until you are paid back. So that is very different than saying, hey, let's go 50-50 on this deal, and we're both going to be owners on this. Or in the syndication route, hey, you put in $100,000 and you are going to be a limited partner in this deal, which means you are going to reap the benefits of ownership and tax breaks while still remaining completely passive and in that role. And you're more protected if anything does go wrong. The limited partners have more protection should something, be mishandled or surprised on the general partner side. Finally, inflation hedge. Real estate values and rental incomes tend to rise with inflation, providing a hedge against that impact. So stocks may not always keep pace with inflation, but real estate can offer protection as the cost of the property and rents rise with inflation. Another thing on here that I love is someone says, hey, let's just say the interest rates drop. What does that do? Is that good or bad? Hey, what if the interest rates skyrocket? What does that do? Is that good or bad? In real estate, there's always going to be, in most markets, shouldn't say always, over time, an uphill trend. The saying goes, it's not timing the market, it's time in the market, which makes real estate work. So the longer you're in it, the longer things are going to go up. However, back to the liquidity issue. Hey, I want to do this deal for 5 years. At the end of the 5 years, I'd like my money back. That is the plan right now. If interest rates are not favorable and we need to wait a little bit longer, we might need to do that. It's still going to be going up. It's just a matter of when are we getting like the best return. So anyway, I hope that helps shed some light for you guys. I think at the end of the day, I love real estate because it allows me to have the most control over where my money's going. But my money is also, my control is being handed to other people that I have to trust in working. And there's just outside influences there, especially if you're going the syndication route. I think there's some certain things you can do to mitigate those risks, such as how many people are really pulling the levers here in regards to general partners on this deal. Is there 3 or less? That's kind of like that's kind of the big number, 3. I think once you start getting into like 4, 5, 6, there's just too many variables of people that could potentially decide or change things or halt progress. I think 2 is like the ideal number. And those 2 people you can vet very heavily and get to know and see their track record and learn their values and see if you align with what kind of things they're going for. As we talked about sort of the control, is there a way that you can get to know the team, the renovators, the architects? I feel like it's just so easy to see track records of a few of these individuals, to do your own due diligence. There's ways to write into contracts with contractors. What is the maximum cost that this project could go? If we have another COVID or something that just skyrockets windows or electrical panels or something that's just odd, we have something written in here that says you can only go this high based on what you've already submitted. So there's certain measures that can be taken that I think give investors peace of mind. And that's really up to whoever you're talking to about real estate to inform you of things that you should know, should be asking. So like for me, I'm not going to know every single team's due diligence process. I have my own process, and a lot of that is within meeting the sponsors and just having a lot of conversations with them about their track record, about their business plan. I have a background of doing single family home renovations, but that can be, drastically different in regards to building new apartments. So I think in who you know is very important. And I trust as you guys explore your options, you could see that the benefits of real estate are attractive, and that maybe having some more education and conversations about it could be a huge impact on your quality of life. The Invested Fathers, that's what the show is about. This isn't the show that says, hey, this is how you make a lot of money because we know that money makes you happy. Nope, not true. I know a lot of rich people who are very unhappy right now. It is that benefit of money in regards to freedom of time and how you use that hopefully is why you guys are investing and looking for those eternal impacts and richness of relationships, particularly with your wife and children, that would cause you to say, hey, maybe I should consider some other options that could really give me some more freedom of time to do those things. Thank you, everybody, for listening. If you'd like to have a one-on-one conversation with me about your investment strategy, stock experience, or, hey, Kenny, what does it look like to invest in real estate with you? Love to bring you into that fold. Find me on LinkedIn, on Instagram. I'm on Facebook under Kenneth J. I'd love to connect with you on. And hey, have fun with your kids this week. Appreciate you guys. Take care. Thank you for listening to this episode of the Invested Fathers podcast. If you liked this episode, we would love for you to click subscribe and leave us a 5-star review. We appreciate all of your hard work as a father and look forward to our next episode together.